I think it's actually 2025. I don't think we should keep drawing these parallels with the past of like, is this 1999? Is this 2021? Because think about it. The world, the economy, the businesses that run the stock market are very different than back then.
Welcome everyone to Investing with the Boys. We are here with Logical and myself, Sam. NVIDIA just reported earnings after hours, and unfortunately, I wish we could actually stream the earnings call, but we can't, but it's fine. NVIDIA right now is trading about 2.6% down after hours, which is okay. The market was fairly flat into close. In my opinion, I looked at the numbers when they reported and they look like they're okay, right? I feel like every single quarter we come to this point where it's like, this is it, guys. This is it. The market's going to fall because this is the top, right? And every quarter it doesn't. And in fact, I would add on top of that, the implied volatility of NVIDIA was actually 88% coming into earnings, which means that we need a pretty big move for option buyers to actually make some money here. 2.5%, that's nothing. For what, a $4.5 trillion company moving at this magnitude, it's not a lot. It is a lot. Holistically, I think that's like about 20, 30, $50 billion. But at the same time, you know, it's not really a big move for NVIDIA. The thing basically 10 times, 20 times like the last couple of years. So we're sitting over here. They're having their earnings call right now. There's some like key highlights of our earnings call that did come up, which we could discuss more during the show. But most of you guys will be watching this hopefully soon. So let's get right into it, man. So, I mean, what do you think about, what are your thoughts about the market right now? Do you think this is the top, or do you think this is just a lot of FUD being spread into the market?
Yeah, I'll jump in with that. But first things first, we want to give a shout out to Shai, who won't be on the episode for the next couple of weeks. We'll miss him, but we'll give you guys a good show in the meantime. Yeah, jumping into NVIDIA, I think obviously that's the major story for this bull market. It's AI driven. And so obviously every person is waiting for those results. And to me, when you have so many eyes on something, it's rarely the time when things implode or go wrong. So just like you were mentioning, in a lot of these scenarios where something is super highly watched, the IV is, priced to perfection, which makes it extremely hard for options buyers to make money, puts and call buyers, and typically option sellers end up making money. So, seeing a flat-ish reaction, I'll put 2-3% downside as basically flat. It's never when you expect something to be down. Like, this isn't going to be the moment. It's going to be when everyone is bulled up out of their mind. Things have like doubled from here probably. And then we have like the true end to the bull market. Now, I'm not saying that we can't have one of these earnings calls end up being, the thing that leads to a 10%, 20% pullback within this greater bull market. And obviously 20% is pretty severe. I mean, that would be like a bear market essentially. But we've seen corrections in this bull market already. We had one in April. That was obviously man-made. That's why it reversed course so quickly. But if the AI CapEx story continues to hold up, which it has, there was really no surprise coming into this NVIDIA earnings report. All the hyperscalers are sitting there telling you, we're going to spend more money than you thought. Our CapEx guide, we're beating our CapEx guide, which means that we're spending more money than we initially guided for. So it's just hard to see in that kind of environment that we're going to get like some sort of implosion from NVIDIA. So, and I know it's obviously a big stock in the market, but remember, it's a big stock in the market, which means it's a big stock in the index, which means it's a big stock for everybody's 401ks, which means that every single week, 2 weeks, Americans are buying a good amount of NVIDIA. So that is a constant, relentless institutional bid that is always going to remain there. So yeah, I mean, NVIDIA, to me, I think numbers are good. Obviously, the second order derivative, which is that the growth, the acceleration of growth or the deceleration of it, is what people are really looking for. So to me, I feel like the alpha of owning NVIDIA has probably not been there for some time. That said, I mean, it's still up a good amount into the year, right? That's another thing, is like people are acting like, oh, this is doomsday. I mean, this stock has a lot of cushion year to date. What's it up this year? Let's see. Year to date, NVIDIA is up 31%. Who cares that we're down 2%? 2%. It's a joke. Yeah, so, I think I'm not really too concerned. I don't think it's going to implode when everyone's watching. I think the second order AI beneficiaries are the things that are worth paying more attention to in terms of trying to capture more of that alpha. But yeah, I mean, so I don't care about NVIDIA. I think as long as the story holds up, which it's already been foretold by a lot of these hyperscalers, we have nothing really to worry about. Look at the market, man. I mean, VIX continues to shrink to the downside. I saw that hedge funds have their highest shorts against the VIX since 2022. People are probably like, oh, that's so bearish. People aren't really, positioned for any sort of upside volatility. It's like, actually, the end of 2022 was a great time to be long stocks. So we could just be in this lower volatility regime where stocks kind of grind higher. And that would be very constructive. You look at the action in SPY today. I mean, SPY just went, it was like another trend day. It was just from the bottom left to the top right and closed near the highs of the day. We made a new all-time high on SPY today. I mean, how could people be bearish? I just don't see it. I don't get it. The numbers are still holding up. We're not at bubbly valuations. Maybe a couple things are a little bit bubbly or frothy, and there's little pockets of like what's going on here. But when you think about the cumulative, collective market cap of all that frothiness, it is a drop in the bucket when it comes to worldwide capital markets. So not really too concerned. I'm mostly focused on where are the trades to take advantage of. I know we're going to dive into more of these software names because that's where we are right now. We're in the software earnings, the part of the earnings cycle where, yesterday we had Okta report, we had MongoDB report. Just today after hours, we had Snowflake and CrowdStrike. Tomorrow we have SentinelOne. Next week we have GitLab. Soon after we'll have Braze. So there's a lot of these software names coming up right now. But yeah, I mean, Sam, I want to pass to you. Get more of your thoughts.
So, dude, I'm actually, this is really interesting that we're having this podcast right now when NVIDIA earnings come out. Like, I'm not on the conference call. If we weren't recording, I'd be listening to the conference call right now. We got CrowdStrike, Snowflake, and NVIDIA reporting on the same day. These are, well, Snowflake and CrowdStrike are pretty big holdings in my portfolio. I don't have NVIDIA anymore, but like half of my portfolio really is dependent and will move in sympathy with NVIDIA. So like you were saying, like NVIDIA is 8% of the stock market right now, right? But if you really consider everything that moves in sympathy with NVIDIA, which is almost every single company in the planet, if NVIDIA goes down, the market will go down, right? If you have a lot of components that build these chips, you have the hyperscalers as well, which is going to be dependent on the commentary on the call as well as the earnings. Like, yeah, if NVIDIA completely misses and they have negative guidance, the whole market's going to fall. It's very difficult to make the argument that if NVIDIA is the reason why the market is up right now, which has a lot to do with it, if NVIDIA is a reason why for the market to go down, obviously the market would go down because of the fact that, like, what would they say? What would people take from the earnings call or the earnings, which I'm actually looking at the numbers right here. I could actually bring it up. So let me just share this screen because I did break down the segments for NVIDIA. Let's just get that on there, Taylor. Yeah. So what we have over here is we have all the segments broken down, and we have, of course, the large blue over here is of course the data center segment, which grew at about 56%. And then we have the gaming segment. Now, this is the thing that I like to bring up, and I kind of want to keep my eyes on. Gaming right now is about 10% of the revenue for NVIDIA. If it reaccelerates, which it did, it reaccelerated up to about 48% from about 42% and continues to reaccelerate, this could actually pick up the slack from the deceleration of the data center revenue, which really has been the eye candy for the last 3 years. If that continues to happen, which I think it will, because you heard AMD's earnings, you saw a lot of the earnings from a lot of the gaming companies. Also, PC computing is actually coming back. You see Newegg up basically like 5 or 6 times the last couple of months because they're starting to see upsale in terms of their gaming parts. If this comes back, we could see this pick up the slack for NVIDIA. It's almost $4 billion of revenue this quarter. If it does pick up the slack, it could be like 15, 20% of a high double-digit growing segment in NVIDIA. And this would totally bunk the thesis that, hey, when data center falls, then NVIDIA is going to fall. Might not be true in this case. So let me ask you this question, because we could talk more about NVIDIA. I could talk about NVIDIA for the rest of this podcast, but people already know about it by the time the earnings come out. But let me ask you this question. I don't know if you read some work from Ben Carlson, but they made a point talking about, is this 1996 or is this 1999? So when you think about 1996, just for preface for the audience, is that 1996 was when Alan Greenspan basically came up with a speech where there is basically an inflated high valuation market or irrational exuberance in the market right now. And that there's a reason why we need to start increasing rates, right? Of course, it wasn't until 1999 when they actually started cutting rates. But if we compare today to back then, people are saying like, hey, Shamat is actually going to open up a new SPAC. All these meme stocks, including Open Door, are rallying off of basically terrible fundamentals. Is this 1999? Is this 2021? Or is this more like 1996 or early 2021, in your opinion? What do you think?
Yeah, so I think it's actually 2025. I don't think we should keep drawing these parallels with the past of like, is this 1999? Is this 2021? Because think about it. The world, the economy, the businesses that run the stock market are very different than back then. I know people are going to constantly say, oh, this time is different. And those are the four most dangerous words in, investing history. It's like, dude, but this time is different. And the world continues to change. If you keep using your mentality from back whenever, you're going to keep underperforming the market. Like it's not, Ben Graham days. We're not using the value investor booklet. We're not looking at price to book ratios to determine if this is a good valuation. Like it's not 1980s anymore where you have an edge just having access to the documents to, validate, this company's financials and stuff. Like, no. News is traveling immediately. It's being priced in instantly. So it is different now. Stop trying to say that it's not, right? So that edge is gone. You can't keep using, old school fundamental metrics to say, oh, this, I saw something so stupid the other day that was like, this market is so much more expensive on a price to book ratio. A price to book ratio? What are we smoking? Like, let's think about this for a second. Like, price to book is based on the book value of the company, right? We're talking balance sheet. Okay. The reason why so many stocks, the tech stocks, command such high price to earnings valuations is because they are asset light. Having high price to book and low book value stocks is by design. It's a feature, not a bug, because these asset light companies are so much better than what we used to have in the stock market back when. So, I think a lot of people who are investing looking backwards don't make a lot of sense. Do I think that, stocks are priced for perfection? Yeah. I mean, generally speaking, I think the Mag 7 have gone too far, or I wouldn't say too far, but I think they can continue to chug along here. I think it makes sense that they are trading at elevated multiples because they're high quality businesses with resilient revenues. They have globally diversified revenues. They have, fortress balance sheets. They have solid management teams that are willing to stabilize the stocks through buybacks. They're cash flow generating machines. They continue to innovate. They go into new industries and new sectors and launch new business segments that end up being multi-billion-dollar revenues. I mean, look at, Google, for example. They have like 7 business lines with over 1 billion users. I mean, there's 7 billion people on this earth. I mean, it's insane how much these tech companies, the ones that lead the index, I think people are just discrediting them. We've never seen anything like these businesses in the last 20 years. So, again, Open Door, should it be trading where it is? No, absolutely not. It's horrible business. I mean, iBuying doesn't work. Didn't work in 0% interest rate environments. It's probably not going to work now in 4% interest rate environments. I think that whole thing is a pump. I remember they were losing money on houses. They were like literally selling houses at negative gross margins. That means that they buy a house at $1 million, they sell it for $950K. I mean, it was pathetic what was going on. And so, and they were sitting on the market for so long. So it's still not easy. We haven't like fully eclipsed the fundamental issues wrong in the housing market. But I would say as rates come down and become more accommodative along with the Fed, you can clearly see more movement. I know in my neighborhood, there's a lot more listings going up. I think people are we're starting to see inventory show up. So, housing can get fixed, but it doesn't mean that it's going to fix a business, in my view, broken business like an Open Door. So yes, there are frothy places, but I don't think it's NVIDIA. I mean, will we look back on this moment in time and say that, the data center build out became, went too far. Maybe because it's possible that the technology starts developing so quickly that a lot of the old technology ends up becoming obsolete. That is a real threat. But at this moment in time, those are the cutting edge technology, and we are nowhere where we need to be in terms of building out the infrastructure needed for inference, which is really the next leg of this data center build out. So, the runway's long, and like you said, is it 96? Is it 99? I think that's a fair analogy in terms of like how much further can this bull market go. And I posed the question earlier to say, what if it's not even 96, 99? What if it doesn't have a parallel to the the .com bubble? Because what happens when we start implementing all of this AI stuff and it gives us efficiencies today, which it is doing, by the way. We're all using ChatGPT. We're all using all these AI tools, and it's actually helping us do better at our jobs and making us more productive, which is going to lead to headcount reduction, which is going to lead to higher operating margins. And so what happens if the efficiencies are gained today and the earnings are able to compound even faster? Does that mean that these valuations were looking back are going to end up looking very reasonable because we were skating where the puck was going, which was higher earnings, which meant that the PE multiples were actually not as high as we thought. So that is still a possibility. It doesn't mean that the CapEx stuff can't have gone too far or become obsolete, but at the time being, that's kind of what we're working with. And so, yeah, I mean, what are your thoughts, Sam?
So check this out. All right. Because I know you mentioned it a couple of times, and the reason why I asked was like not looking for a parallelism, but looking for the idea that in 1996, people were essentially trying to call a top, right? And I'm not saying that, hey guys, that means that in proportion in 3 years, whatever, that this is going to be the top. What I do mean is, if I look at this image here, we have this from Britholtz Wealth Management. Basically, it's showing from a scale of 1990 all the way until the top of the bubble of 1999 for the S&P 500 price, following Greenspan's speech, December 1996. And clearly, there was another 3 more years that the market had to go. But at that point, you had what we had today. Every single not every single, but a lot of macro experts out there and a lot of valuation experts out there basically saying like, Alan Greenspan has a point, who was the FOMC chair at the time. Valuations are very inflated, right? So how much higher can we go in comparative to, whatever time they had to compare it to, whatever time period? Does valuation actually mean or have a definitive idea of when or around the market will actually top? I'm in agreement with you at the same time. Technology on a historical basis actually gets better double the amount as the previous year for every single generation that comes out. If you look at the phones that come out, specifically with the iPhone, I don't want to say that they're 100% or 50% better than the previous year. Actually, they're around 50% better than the previous year's model, but not double necessarily. But if you look at the scale, how fast technology is improving in terms of, let's say, the GB200 versus the H200 that was out last year, it is that much better. You have power more efficient. You have cooling more efficient. You have processing more efficient. You have computing more efficient. Everything else is a lot better. But that's not the only part of that entire stack. There's multiple parts of the data center stack. There's networking. There's internet connectivity. There's the actual, I guess if you want to get to the memory and the specifics that are actually part of the GPU, which makes the whole GPU whole. But that all gets better. But the thing is, that's not getting better linearly, that's getting better exponentially. So 100% better than last year is, what is that, like 300% from the previous year? I can't do the calculation in my head, but it is way better than the model 2 years prior, and it's not linearly.
Sam, like for real. And think about this, right? The main thing that the bears who try to compare this to the .com bubble, which they have no clue what they're talking about, because again, I've mentioned this on a prior podcast, but like, dude, Amazon IPO'd in 1999. I didn't make my first order or package. My first package was not delivered until 2012. 13 years later. Guess what, man? OpenAI has a crazy valuation. Dude, and not to say I'm bearish Google, but dude, I've like stopped using Google and I use ChatGPT for everything now. It's like we are actually implementing these things immediately. We are seeing the efficiencies every single day. I now sub to ChatGPT. So does my wife. Like, we're at a point where these things are taking over our lives today. In 1999, we did not have the infrastructure. The technology was not there to be able to implement things immediately. We already have the rails, the infrastructure to do all this right now as it's being developed. That is a key differentiator. And I wanted to pose one more question to you. Dude, what are people's fixation with trying to call a top? Like, what are they doing? What can I ask? Like, what do you think actually, like psychologically, what is this fixation?
I mean, I think that there's two different things at play, right? You have people who miss the rally, so they try to use their voice to potentially call the top, so the market, they could have an impact to the market selling off and they can catch up. There's that aspect, which, don't get me wrong, there's a lot of big money out there that didn't buy the dip in April and has waited and waited and waited till they get that dip. No opportunity until then. We haven't had more than a 5% correction since April, right? We've just been essentially going straight up. And then there's people who are trying to grasp the credibility that I called the top in 2025, right? Or the same people who called the top in 2021, which I would really attribute to a similar scenario where people tried to call the top then, but how long did it take you to be right? Right? There were a lot of people who called the top in May of 2020, right? When the S&P 500 made a new all-time high, called the top, double top, double top, double top. And they were right, but it took them an additional 30% higher. And on top of that, over a year and a half to be right. What is the point in calling the top? In my opinion, I think it's great, probably for short-term traders, but you would really attribute that as a stop loss, right? There are people who call the tops, but in my history of talking to a lot of traders my whole life, especially listening to a lot of gurus out there, the all-time high is never a good time to call the top because all-time highs are bullish. All-time highs are clustered scenarios where when you have all-time highs, you tend to have multiple all-time highs clustered around that period. Wait for the breakdown. Right? Wait for the catalyst, whatever it is. Like, there are a lot of people who were bearish in February around the all-time high. They didn't short. And I know you, for example, we were doing these podcasts, right? We were all bullish in February. We were all kind of hesitant mid-March. I think you were pretty bearish around then, but you didn't need to nail the top.
To be fair, though, I was bearish February 20-ish or something, right around the top. And I'm not saying that in a hindsight thing, we can go back and check, but that was specifically because the tariffs that were being proposed were absolutely ridiculous and would destroy the economy. And guess what he did? He walked it back.
Yeah.
And that's why I'm back to being bullish. So if there's a actual reason, what's the reason? I want to sit down these bears and ask them a question. Is the reason for the top or the breakdown in the room with us today?
Well, I have to say that this is the funny thing, because I know I'm going to get hit with a lot of slack for this, but bears usually sound the most logical people out of everyone, right? It makes sense. Why are we cutting?
Oh, there's always something
into rampant, sticky inflation and an economy that's starting to slow down, that's still speeding up. Why are we cutting rates? Or jobs are slowing down, or the housing market's slowing down. Why are we cutting rates? We need to cut rates. We had ridiculous 0% interest rates for over a decade. Why do we need to cut? Yeah, that makes sense. But you were also wrong for the last 5 months, and you were also wrong since 2022. So when are you going to admit you're wrong? And I think that when they admit they're wrong, when I'm not saying a specific person, when the majority admits that they're wrong, that is when the top happens.
Well, that's the thing, right? Exactly, right? It's a lot about positioning. Right now, when you continuously see people being cautious, that means that they're not long. That means that not every single person is long in this market. I see so many posts of I'm raising cash and blah, blah, blah. That means that by definition, not every person that could be long is long. I'd be more concerned when people have thrown in the towel and they just forfeited to the idea. And so for me, investing in a specific stock, always one of my biggest considerations is positioning. I prefer to buy a stock when it's actually near its lows rather than when it's at its highs. I know that sounds silly because a trader would say, well, I would rather have a winning stock that keeps going up. I agree. I get that too. There's both sides that make sense. But my point is that when a stock is already sold down to its lows of the range, who is left to sell that stock? Nobody. But there's a lot of people who can buy the stock still. So that's my thought is and again, you look at that and that's why we have short squeezes, because when a stock is highly shorted, there are 2 times the number of buyers. Actual buyers that want to be long the stock and people who are short the stock that have to cover by buying the stock. So there's more buying pressure. Right now, I still feel that there are people sidelined, like you were mentioning, they missed the rally. So there is still, in my view, buying pressure. We are still climbing a wall of worry. Like you mentioned, dude, the bear narratives, I understand that we're bullish and there's people who are just as bullish as there are people bearish, but not everyone is bullish is the point. There's still many people who are bearish. There's still many people who are calling the tops. Why are you going to call the tops? Actually, I remember, I think it was Meb Faber, he did like some analysis a while ago. Basically, he did something where it said like, buying stocks while the S&P is within 5% of its all-time highs have yielded much better results than if it were not the case. So you're better off continuously buying stocks as they continue to make new highs. And ultimately, like you said, a top is never going to be something you're going to be able to call proactively. It's more likely going to be something that after the breakdown, you'll know in hindsight that was the top. Unless there is something, like for example, like I don't think I was as smart back in 2021 and 2022 in terms of like Fed policy. I think we all went through a crash course of what happens when you raise rates from 0%, high inflation, all that stuff. I think we've all had a crash course there. But what I can say is clearly bringing the economy to a halt, reducing the amount of fiscal stimulus that's been going around through all those stimmy checks, and then also taking us from 0% interest rates to 5.25% in a little over a year. I mean, that is like slamming the brakes on the economy while valuations were at all-time highs. Right now, you don't have that situation. We are not raising rates, right? Like, I think maybe one argument you could say is like, look, we're still spending at extreme levels of fiscal deficit spending. Okay, so wait to see if they bring fiscal deficit spending down. And then you can maybe say, hey, look, like liquidity is leaving the system. But right now, they continue at the government level to basically spend like drunken sailors. We are about to get rate cuts, which means that more liquidity into the environment. So it's like, what's the bear case? I understand people's concerns, like, hey, we're going to get sticky inflation. We're going to, this is detrimental to the economy long term. Sure. People have been doing the detrimental to the economy since, we're at 9 trillion debt. Now we're 4 times that. People could have made that argument a long time ago. So, it's coming. The question is, do you want to participate or do you want to continue to be sidelined? And so that's kind of what I'm thinking. And there's no point in trying to go against the current. The current is to the upside. What are we doing?
Yeah, so I actually have this chart that I wanted to share. This is from JP Morgan Chase, right? This isn't updated for Q2 because we haven't actually finished out Q2 yet. But as far as what I've read lately is that earnings actual for this year in terms of growth is actually around 11%. Let's take a closer look. We have a pretty good idea where the S&P 500 was around these times, right? 2022, market was at all-time highs, and we were pulling back, whatever. Look at the expectation for earnings. It was at 15% growth for Q1 2022, and it came in below expectations. Had a little bit of bounce, and then below expectations. But it was around this point when the banking incident happened with SVB and so on. Since then, expectations have been materially lower than the actual results. Okay? Let's look at this quarter. Earnings yield expectation year over year was around 5%. Actually, I'll tell you firsthand, it was around 3.8%. What I have seen is that it's actually around 11%. Like, you talk about positioning. Positioning is from a technical perspective where actual positioning is, but then I'm looking at sentiment as well. Positioning and sentiment really sets where the market is today. If you had analysts, Wall Street analysts with SP 500 targets around 6,200 and then lowering it to low 5,000s during April, and then now today you see Goldman Sachs saying it's about 6,600. You have every single Wall Street analyst trying to up their targets as the market goes up. And then you have earnings expectations for Q2 2025 around 3.9%. And then earnings yield are actually 11%, they beat expectations. And the market has to re-rate itself. You have revision after revision after revision on SP 500 targets for the end of the year. And on top of that, you have revisions of the actual micro companies themselves constantly going upwards. That is what pushes stock prices up. That is the reason why the market continues to go up. It's not because of the valuation. It's because People expect one thing based on today's valuation metric, and it comes up higher. So guess what? People will buy stocks if that happens because they want to front run that actual result. And that is what the market does. It is a front running mechanism. Markets are 100% inefficient. If they were efficient, there wouldn't be a stock market. And this is the reason why bears make so much sense. They're so logical because it makes sense looking at today's data. But the market is forward looking and it will never be based on today's data. It's based on what will happen, not what has already happened. That's why when earnings come out, they beat earnings, top and bottom line, but then guidance was terrible, right? Why is the stock down? Well, the stock's down not because of their past performance. It's down because they're guiding for a bad quarter, a bad year up ahead. So no one wants to hold that stock into that quarter. That's the market moves on those expectations and the positioning as well. Like you said, earnings estimates are too low, but everyone is bullish. Who's going to buy after that? No one.
Yeah, no, I hear you. I'm on the same page. And here's another thought, right? Like the main bear case continues to be, well, there's a few, but like, let's say it's inflation, right? Okay, first off, we are not seeing those supply shocks like we did with like the whole world shutting down and 2020, 2021 COVID level, inflation increases of 9% year over year. We're not seeing that. I know everybody is like crying about inflation and, whatever. Dude, we're still under 3%. Now, maybe 3% is the new 2%, right? And I'm not a fan of that. At the same time, even Jay Powell says, we're probably going to see this one-time price hike from tariffs. And then next year, we should be lapping those differences. And if anything, tariffs should have demand destruction through those price increases, which is going to end up being disinflationary or even deflationary at some point. So I don't necessarily really put a lot of credence into the inflation argument. Also, because it's just not like at the 2020, 2021 levels of what or 2022 levels. Also, if we think about inflation, what do you want to own in inflation? People are going to say first thing is probably gold. Okay, fair enough. But the second best thing to own probably is stocks. Because why? Yeah, I mean, assets for sure. But think about stocks. The reason why I'd prefer to own stocks over gold in an inflationary environment is, yeah, I understand the dollar's losing value, etc. So you want to own gold, hard assets, whatever. Fine. But when we talk about stocks, they are the best hedge against inflation because we have management teams that can have dynamic business strategies, dynamic pricing strategies to pass on that inflation to their consumer. So if we're going to run this economy hot and the fiscal deficit's going to stay high, and even Trump is talking about sending more stimmy checks, which is ridiculous. Look, I'm not in agreement of any of these things, but they're the facts of what is going on. Now you can choose to disagree with it, but still invest and participate and not hold your bias in these scenarios, because I think some of the greatest wealth building opportunities are going to be in these moments where we have this kind of inflation, and assets are the best way to hedge yourself. And again, having these businesses that are able to keep their margins intact so that they can have these, continue to have these revenue growth opportunities that's going to flow down to that bottom line, and they're going to continue to compound that EPS year over year. So that is going to be the best thing. And even in like, let's say the 70s when we had, max inflation, I do think that stocks did not keep up with inflation. But guess what? If you kept cash, you got absolutely destroyed. So how is that a better alternative? If we are running it hot, you need to own assets, and stocks are one of the best, if not the best way to hedge against inflation.
So let me ask this question, because you were mentioning earlier that there's more inventory coming to the market. For the audience, we both live in LA. Logical lives more in probably a more city area than I do. I live in a little bit of a ghetto area, but anyways, we both kind of live somewhat close to each other. I would say within the city limits of LA. And one thing that we've both been seeing is that, well, there hasn't been much inventory. And the problem is that even though there's not much inventory, it doesn't mean demand's going to be higher. There was really no demand. And that's mostly attributed to interest rates. So we've had probably an upward move in terms of long-term yields, which is really what mortgage rates do track. They track rates more in the long end of the curve, so around 20, 30 year, usually the 30 year, which isn't really consistent too much with the moves on the short-term end of the rates, which is what the Fed controls. The Fed controls the short-term rates, right? The closer you get inward to the curve is what the Fed is actually controlling. They don't control the long end of the curve, which is more attributed toward yield curve control. So the Fed is going to cut, right? Does that mean that the housing sector is going to come back? Not really, because that's a long end of the curve. The Fed does not control that. But they made commentary that this is last Friday. So we're recording this episode on Wednesday, August 27. Last Friday was before we recorded that previous episode. We had Jerome Powell during the Jackson Hole event, which was, I don't know, the market was up 2% that day. I guess it was bullish, right? It was dovish. It was very dovish. It was more dovish, more dovish than what the market expected. Everyone went into that day expecting a rug. I expected a rug. I was like, I'm going to be rug today, but I'm cool with it because I have a longer time frame, so I'm fine with it, right? Everyone expected it. He did not rug anyone. He did the opposite. He said, look, we have our rates model that we expect where inflation to be at. We're going to readjust our framework. That was the key word. The market heard that and it ran after that because readjusting their framework means we're able to deal with higher than 2% inflation targets, which means that we can cut rates sooner. And now currently, let me actually share this screen right here. Taylor, why don't you throw this on for us? Oops. I'm going to share the CME Fed tool. And let me know. Yeah, there you go. So we have here an 88% chance that we're going to get a rate cut in September. So if I look back on the probability ranges, a month ago, we were at about 61%, right? And I can tell you from firsthand that this was actually a lot lower. I think it was around 30% more than a month ago. But if we look at the terminal rates for the end of the year, we're looking at about a 40% chance of 3 rate cuts and a 48% chance of 2 rate cuts. So that means we have at least around a 90% chance of getting 2 rate cuts this year, at least 2 rate cuts. The market was not pricing this in before. It thought we would have at most 1 or maximum 2. Now we're pricing in at least 2 rate cuts of a 90%, pretty much most likely probable chance of happening amid PCE inflation coming in on Friday, which I think is going to be a nothing burger. We're going to get at least 2 rate cuts this year. What if it's 3? Why?
I've been in the camp of 3. I was in the camp of 3 last year, and we got 4. We got 4 last year, and I was in the camp of 3. So
exactly,
anything can happen, dude.
And I know you're talking about small caps all the time. Rate sensitive companies. People wonder, hey, why is the IWM not running? Why is that? Because the cuts expectation was not. It was like pretty much stagnant the whole year. And then Jerome Powell had his press conference at Jackson Hole, and IWM was up 4% that day. Since then, I think it's like pretty much flat since then. Yeah, it's actually up since last Friday. But why? Because more rate cuts are being priced in. Rate sensitive companies are doing a lot better now because they can now take out debt ahead of time or refinance debt later on at a much cheaper rate than they could. Well, what do you have to say to that? Because I know you're a lot into the small caps.
Yeah, let me just share my screen. Taylor, if you can just throw my screen up there and we can kind of look at this chart, because here's the IWM, man. It just, look at this.
Look at that thing, man.
This is the Friday candle. And here's an inside day, boom, outside day broke out to the upside. Look at that. Highs since, when was this? November, back when the inauguration, or not the inauguration, but election day happened. So look, you're seeing a lot of strong action. Does this look bearish to you? And we're talking about, small caps, which are obviously led by, look at KRE, which means lower rates are definitely coming, and these things are responding really well to it. People are actually sitting there being bearish when these are the charts that we're looking at. We can look at biotechs as well. Biotech's a little bit less, but look, still
I saw that. It's back in the 90s. Averages. That's crazy.
Dude, I mean, here we are, man. So, I'm just thinking about all these, and then we could talk about XHB, home builders. I mean, these things are definitely, and it's so funny. Everybody in the world was so, they were talking about Warren Buffett's purchase of United Health. Dude, that was kind of expected. People thought that was the big story. No, the biggest story was that he was buying D.R. Horton's and Lennar Corporation, which are 2 home builders.
It wasn't just him.
Look at the home builders now. Yeah, it wasn't just him. There were several of these super investors that were buying them. And they were buying, dude, there was a guy who was buying this Smith Douglas. I mean, it's a small cap, 90% of it, 88% of the shares are being held by the founder and the CEO. I mean, there are these things like Green Brick Partners, which is a this is David Einhorn has like 25% of his fund invested in this thing. It's like
I agree.
you know,
Greenlight Capital. I knew you were going to talk about that one. Yeah.
Yeah, that's another one. Man, dude, I talked about, look, Builder's First Source. Look at this thing. It failed above the 200 day and it came back down to the 21 EMA, this purple line. Boom, here's that Friday candle from Jackson Hole. Look at these tight action 1, 2, 3 inside day candles. And we saw how the IWM basically settled out. It broke out higher. And so you're telling me we got 4 closes now above the 200 day just after being rejected and reclaiming it?
That's a major move. Reclaim the 200 days, like the most bullish move you can see after being undered for so long. That's exactly what happened to SP 500. Hey, what are some software stocks you're looking at? Because I know you're eyeing a few of them, especially when they reported yesterday.
Yeah, I mean, obviously we could talk about software. You know, let's pause from some of these. I'm gonna stop sharing that. Let's just chat through some of what's been going on the software side of things because I think the housing side, obviously that trade is definitely taking on the rate cut sensitives. I will be full disclosure. I'm like 160% long in this market right now. I am pushing it because I'm very paranoid about how I manage my exposure. But I'm sitting at about 105% year to date. I'm ready to push that.
That's crazy.
Yeah, but let's talk a little bit because we had a huge move today in MongoDB. I know you're a little bit more connected with that one.
Oh yeah.
I know we chatted with it on with like maybe it was last week or 2 weeks ago with Shai, and he was mentioning like MongoDB is priced pretty expensive. But what we're noticing in this earnings cycle is that Palantir, Cloudflare, MongoDB, like the ones that are really expensive, as long as they deliver, and by deliver, I mean being able to show acceleration in growth, market is willing to bid these things up like crazy. So those have been the true winners of this cycle. And today it was up 38%. I mean, just incredible.
Let me go over this chart. Let me go over this chart real quick. So we got basically the most profitable segment of MongoDB. It is their Atlas DB cloud native product. Basically, this is the MongoDB platform, which is an open source product, but this is the cloud version of it. This is a version that people or companies don't have to manage anything in the back end. They just need to put their data in, process it, and so on and use it, right? Just look at this chart. Obviously, this is a bullish company just looking at this. There's many factors according to this, but if you look at the chart for MongoDB, it basically has been trading at suppressed valuation since their quarter when they announced that, hey, we're gonna run into a little bit of a bumpiness on the road for our all-star product, Atlas DB. Last quarter, look at this big green bar right here. It grew a lot faster than it did in the previous quarters. And again, what have we always said with expectation versus actual, right? If you beat consensus expectations, you're going to run. That's exactly what MongoDB said. You said that they did today. 38% up. It's actually up another 1 or 2% after us. It's probably going to continue running because Snowflake reported earnings day. I didn't get to take a closer look at it, but Snowflake was up more than 10% after hours. I mean, software's coming back, man.
Yeah. I mean, and Shai was totally right. This guy covers software really nicely. And, he's been talking about the consumption models, the infrastructure names, the platform plays. Those are going to be the standouts. Even though they're expensive, they deserve to have expensive premium multiples. And that's exactly what's been playing out. And those have been the winners. For example, Snowflake obviously killed it today. It went into the print pretty expensive. I'm an idiot because I sold that thing at like 180. Now it's sitting at 225 in after hours. That's life. I'm just a GRBK kind of investor. For those that don't know, that's growth at a reasonable price. I try to stay away from growth at all costs. But these are high quality businesses clearly, and they have big major tailwinds. They're riding the AI narrative, which is more data. It's exponential, blah, blah, blah. But for example, yesterday we had Okta report. I like Okta because, I've worked with the software a lot, and it was not a demanding multiple. I was actually doing a workshop yesterday, and I was kind of going through the numbers on that report, and this thing is trading at like under 19 times free cash flow, actually less now, probably like 18 times free cash flow, growing the top line 11%, 12%, bottom line is growing 25% year over year. It is trading at less than 1 PEG ratio. So it's a very high value. I actually added to that stock as it faded today, but it's just crazy to me because it's like, this stock is really cheap. It's a high quality business. Their earnings call was actually way better than expected. I mean, so I listened to the call and I'm thinking like, why isn't this stock up more? I mean, I thought they beat expectations. What's going on? I listened to the call and I'm like, they sound upbeat. They sound bullish. I mean, they're talking about, oh, our prior guide in our last quarter, none of those fears materialized. Great. Net retention, we believe, has bottomed. Fantastic. We actually believe that AI agents will end up contributing to our revenues because we're going to need AI identity solutions for these AI agents within businesses. I'm like, whoa, that's crazy. I didn't even think about that. So I think right now we're starting to see, and we've been talking about it a long time. You know, we had an episode maybe a couple weeks ago called "Did Software Bottom?" Right? Because we had the AI tsunami, the narrative is taking hold, and then we're getting these earnings prints, and they're not as bad as expected.
Well,
and that's exactly what we've been talking about.
I think we're in mutual agreement that because there was a bit of talk, you know, we weren't really feeding into the FUD there, but we were kind of being a little bit realistic. Like, look, there is a time and place where software is actually going to be hit by AI, because when you're aggregating data into basically whatever chart that you want, just by providing it to an LLM and just getting whatever you want, you know, what is the use for all of this software at that point? And that is like just scratching the surface with the argument there. But I think we all knew that this was not going to happen right now. This is going to take like 4 or 5 years or more to play out. With that being said, that was the fear that the market was serving, or that was the narrative that was being fed to people, was that it's happening right now. It was not happening right now. It's not, it's going to take years for that to happen. In fact, we haven't even seen the massive effect from the efficiency of AI compute that we've seen today. It's going to have a much more dramatic effect. It's going to take a really big toll on exactly how companies operate, but that's not going to happen for a long time. It's not going to happen for like 5 or 10 years for any of that to take place. And that's kind of what we saw. We saw reversal of the expectation. People expected MongoDB to pretty much print an okay quarter like they always have and basically be flat for an entire quarter. Instead, they came in with a reacceleration in Atlas DB, which is now, I think it's about 73% of revenue. And of course, like I mentioned before, this is a very high margin business for them because there's a lot of overhead that they cut for a lot of clients, and also the scalability makes it a lot more profitable. Very important. The company is almost back over $300. It hasn't been over $300 in over a year now. And seeing that happen, what do you think is going to happen with Wall Street? Oh, they're going to revise their price targets. They don't want to leave their clients. They don't want to leave their clients hanging. They're going to revise their price targets, keep them up there. There was actually one report that I saw from, I forget the name of the analyst firm, but they increased the price target from like 225 to 325, which is crazy. Like, what, as an analyst in Wall Street, not actually, it's better I didn't say the name of the analyst per se, but don't you think you would have seen any of that coming, considering all the research that you do? In my opinion, this is the reason why sometimes long-term investing comes to play, especially as a retail trader or retail investor, because you don't need to wait for that sign to go long. You just need to know the fundamentals and put in whatever amount you want to put in and then let it ride, right? A lot of these other companies, a lot of these analyst firms and money management, hedge funds, whatever it is, they can't just do that. They don't have that optionality like we do. So as a retail investor, we have that edge. We can buy the dip in April because we know these companies are going to be fine in the long run. Wall Street, on the other hand, they can't exactly do that, right? So that's why it's like, know the things that you own and just stay sound to whatever information is going to come in, but just stay with the long-term trend.
Look, I want to even bring that thought. I think that's a very good general thought. And then like bringing it right back to software and like what we've been seeing. It's like, we're looking at the valuations of these businesses as the stock price goes down. And we know that it's mostly narrative driven because we have yet to receive any numbers from these companies. So we're all just like pretending like we know what's actually going on. And then the numbers come in and they're not as bad as expected. And all we did was price in these really cheap valuations for world-class businesses. So that's what we were saying 2 weeks ago on our episode. And we said, like, I was like sitting here and I went on a rant talking about like, like Braze software, Amplitude, or GitLab. And we're talking about like, dude, GitLab is putting up numbers like Snowflake and it's trading at half the valuation. We're talking about 27% revenue growth, 35% free cash flow margins. I mean, those things are having monster days now because people are seeing reports like MongoDB and Snowflake right now. And it's like, hey, did we just price in too much downside for software? And I'm hoping we just called the bottom, and I've built a large basket of software stocks. So, I have a few more reporting in this coming week, and I'm excited to see what they do. But here's what I'll say. What people need to understand when they're buying stocks is that they're investing in a business. And so when you look at the share price, what that's telling you is the market cap of that business. When you look at the market cap, now you can build a valuation. So the lower the price, less risk, not more risk. And so when we go into these prints, the valuation, if it's low, that's telling you that the expectations of this business are low. So there's less risk. There's more margin of safety at these valuations that you're paying. And guess what? We're getting these reports and they're looking pretty good. So it's so silly. Like you said, the AI tsunami, which is going to destroy like probably half of these businesses, isn't happening this year. And I don't think it's going to happen to the high quality scaled up businesses as easily as we think it is. These things are narrative and sentiment driven at the moment. We need to actually see that show up in the numbers before we get ahead of ourselves. So that's kind of my thought process here, and I'm still looking forward to the rest of these kind of software earnings. I don't think the market's going to come down here. I mean that's pretty much it. I'm looking forward to it.
Yeah, I'm not going to disagree with you there. But at the same time, I mean, anything can happen, right? We got Core PC on Friday. Who knows? Who knows? Like, I don't like to discount the fact that anything could happen because it can, right? And if we knew what was going to happen, then April would not have been a 23% down peak to trough in the market. But yeah, no, I hear you, man. I mean, we got a lot more earnings still on the horizon. Like you said, actually, I was going to bring up the earnings calendar here. But I guess I will, right over here. So tomorrow we got Dell. Dell's going to be reporting after hours tomorrow or Thursday because we're recording this on Wednesday afternoon. We got Marvell Technology, AFRM or Affirm, Alta, SentinelOne, which is a very big software company when it comes to endpoint client management, cybersecurity. And we got IREN, which is actually really interesting because a lot of these Bitcoin mining companies are now turning into high performance computing mechanisms. So that would be very interesting. Alibaba reports on Friday before open, and next week, finally, actually, we have a little bit of a quiet week. Maybe not for you and I, but on Tuesday after close, we have Zscaler reporting earnings, which is another network cybersecurity company. And Wednesday, we got Salesforce, and we have GitLab reporting. GitLab is, of course, another holding that you and I have. And I think that's, my bad. Broadcom is reporting Thursday after close, as well as Lululemon. So we'll see what happens with that. But other than that, man, earnings season this quarter, of course, did not disappoint. It is always a rodeo every single time. And I mean, I think that wraps it up. You got anything else to say, Logical?
Yeah, sorry, I couldn't find the mute button there. But I have GitLab with you next week, and I was just looking up Braze to see when that is, and it looks like it's September 4. So what is that? That's next Thursday. So I got next Thursday. I think it's next Tuesday. Yeah, next Tuesday's GitLab. Next Thursday is Braze. I'm going to definitely stay in those. I'm actually in SentinelOne for a trade. I saw some bullish call activity come in, and the stock's sitting right at support. I don't think it's like a super high quality business, but it's growing like 20% or so top line, and it's trading at 4 times EV to sales. They have enough cash where they're like, with interest income, parking, and short-term investments, they're able to like, until they inflect the profitability, which they're guiding for this year on the operating business, they're able to kind of slow down that cash burn. So I mean, look, it's not in a bad spot, and the stock is way down. I'm taking a stab, 4% position, see what happens, let it rip. But yeah, I mean, I'm always okay to, take swings and, best case profit, worst case tax write-off on these realized capital gains I have this year. And that's kind of how I manage my portfolio. And I just let it rip, dude, and I don't really care.
Yeah, I just let it rip. I don't care, man. All right, guys.
We'll see, man. I don't know.
Yeah. Thank you for tuning in, guys.